everyone talks about Bitcoin and Ethereum. But quietly, in the background, something else has become the real backbone of crypto: stablecoins. They're not exciting, they don't promise 100x gains, and they rarely make headlines. Yet without them, the entire digital economy would freeze overnight. The truth is, stablecoins are no longer just crypto tools. They're becoming the new banks of the blockchain. Let's start with a simple truth. People don't move markets with dreams, they move them with dollars. And in crypto, those dollars exist as stablecoins. Whether it's USDT, USDC, DAI, or PYUSD, these digital dollars are the oxygen of every exchange, every DeFi pool, and every on-chain transaction. They're the bridge between old finance and new finance. But recently, that bridge has started to look less like a tool and more like a central power structure. So let's break it down. What exactly is a stablecoin? It's a digital token that's meant to track the value of a fiat currency, usually the US dollar. You send one, you expect it to always be worth one. Simple in theory, revolutionary in practice. Because it lets you move money anywhere, instantly, 24/7, without a bank. No approvals, no delays, no borders. That's not just convenience. That's a complete rewrite of how money flows. But here's where it gets interesting. Not all stablecoins are equal. There are two main models: custodial and decentralized. Custodial ones like Tether, USDT, and Circle's USDC are backed by real reserves, cash, treasuries, commercial paper. They're run by companies, audited by firms, and in many ways, they behave like digital banks. Then there's the decentralized kind, like DAI, which is backed by crypto collateral on-chain. It's algorithmic, transparent, and, in theory, censorship-resistant. But even DAI today holds large amounts of USDC in its reserves. So the line between centralized and decentralized is fading fast. Now, think about this paradox. The most used assets in decentralized finance are centralized stablecoins. In 2020, that sounded wrong. But in 2025, it's reality. Why? Because trust moved from code back to reputation. People prefer a dollar that's boring but reliable to a token that's pure but unstable. And that shift tells you everything about where crypto is heading. We're building open systems, but the rails are being owned by a handful of issuers. Let's talk numbers, because they reveal the scale of this transformation. The total supply of stablecoins today is over $160 billion. In some days, more than 90% of all on-chain transactions involve one. Think about that. Stablecoins now settle more value per month than Visa's global network. In fact, USDT alone handles more dollar transfers than PayPal. That's not a niche experiment. That's a parallel monetary system. So what happens when a few companies control that much flow? They start to look less like issuers and more like private central banks. Tether controls liquidity in emerging markets, Latin America, Asia, Africa. Circle dominates regulated corridors, the US, Europe, institutional DeFi. Together, they form the new twin pillars of digital money. And while central banks still print paper, these companies mint code that travels faster, cheaper, and often more trusted than local currencies. Here's the quiet revolution. Most of crypto's liquidity is already dollarized. The supposed enemy of the banking system, crypto, is now powered by its own digital dollar ecosystem. And that's both genius and dangerous. Genius because it brings global liquidity to anyone with a phone. Dangerous because power is concentrating again, just on-chain this time. Let's pause and ask, who holds the reserves? Who audits them? Who decides who can redeem? When Tether freezes funds linked to investigations, it shows it can act like a regulator. When Circle blacklists addresses under sanctions, it shows compliance can override decentralization. That's the trade-off: freedom versus control, efficiency versus censorship. And each bull run pushes that balance further toward control, because institutions prefer compliance over chaos. But there's a deeper layer most people miss. Stablecoins are not just for trading, they're becoming infrastructure. Think of them as programmable settlement layers. They're now embedded in lending, derivatives, gaming, real estate tokenization, even payroll systems. When a company pays freelancers in USDC, when an NFT marketplace settles fees in USDT, when a DeFi protocol uses stablecoins as base collateral, that's not speculation, that's adoption. Stablecoins are doing what Bitcoin promised. They're turning crypto into an actual economy. Now combine that with the next wave: tokenized treasuries and RWAs. Big funds like BlackRock and Franklin Templeton are launching tokenized versions of US bonds that pay real yield on-chain. What do they settle in? Stablecoins. Because stablecoins are the default digital dollar, the liquidity glue connecting everything. As RWA tokens grow, stablecoin usage grows with them. In short, stablecoins are the base currency of the digital economy, and they're quietly replacing banks as the settlement layer. But every revolution comes with a cost. Stablecoins bring new risks that most people never think about: custodial risk, concentration risk, regulatory risk. If Tether or Circle ever face a major freeze, a lawsuit, or a political shock, billions in liquidity could vanish instantly. We saw a glimpse of this when Silicon Valley Bank collapsed and USDC briefly lost its peg. That small incident wiped billions in market value in hours, not because crypto failed, but because a traditional bank behind the scenes did. It proved that even digital dollars still depend on legacy infrastructure. So, what's the endgame here? The competition between private stablecoins and central bank digital currencies, CBDCs. Governments are watching stablecoins dominate payments and they don't like it. So they're building their own digital currencies. But here's the irony. CBDCs are slow, tightly controlled, and privacy-free. Stablecoins are fast, global, and flexible. People vote with usage, and they're already choosing the private option. That's why the US is quietly allowing regulated stablecoins to grow. They're the soft version of a CBDC. Same power, less backlash. Think of it this way. In the future, your digital wallet won't say Bank of America. It'll show balances in USDC or USDT. You'll earn yield from tokenized treasuries, spend directly from your wallet, and settle cross-border payments in seconds. No SWIFT, no delays, no foreign exchange fees. The stablecoin economy makes money as easy to move as a message. And the moment that happens at scale, traditional banks become irrelevant middlemen. But with great efficiency comes great fragility. Because when 90% of all digital liquidity depends on one or two issuers, the system's decentralization becomes an illusion. If one stablecoin depegs, everything that depends on it, DeFi loans, liquidity pools, on-chain funds, breaks. It's like pulling oxygen out of a room. That's why real decentralization can't stop at blockchain. It has to extend to the money we use inside it. There's a movement now to fix that. Projects like USDX, Ethena's synthetic dollars, or MakerDAO's new RWA-backed DAI 2.0. They're trying to make stablecoins both decentralized and yield-bearing, a hybrid between crypto logic and real-world collateral. If they succeed, they could create the first truly global, censorship-resistant digital dollar. But if they fail, we'll slide further into centralized digital finance, efficient, profitable, and controlled. Let's zoom out and think about what this means globally. In countries with unstable currencies, Argentina, Turkey, Nigeria, people already use stablecoins as a better dollar. Street merchants accept them. Families save in them. Developers get paid in them. Stablecoins are becoming grassroots monetary policy. That's real adoption, not hype. When your local bank fails but your USDT still works, you don't care whether it's crypto or not. You care that it works. That's why stablecoins are spreading faster than Bitcoin in real-world usage. So here's the paradox. The technology built to escape the financial system is now rebuilding it. On-chain, faster, more open, but still centralized around trust. We replaced banks with smart contracts, then rebuilt banks inside them. The difference is this time, anyone can plug in. Anyone can be their own bank. And that's both empowering and dangerous, because responsibility is the new regulation. When you hold your own stablecoins, there's no customer service, no bailout, no forgot password. That's the fine print of freedom. Let's talk about what to watch next, because the stablecoin war is only getting started. First, regulation. The EU's MiCA framework and the US stablecoin bill will decide how these tokens are issued, who can hold reserves, and which banks they partner with. Second, interoperability. Projects like Chainlink's CCIP and Circle's cross-chain transfer protocol aim to connect stablecoins across chains, a crucial step for scaling real payments. Third, competition. PayPal launched PYUSD, and others will follow. Big tech wants a slice of programmable money. The question isn't if, it's how fast. And fourth, on-chain yield. When stablecoins start earning yield from tokenized government bonds, people will begin to treat them like savings accounts. That will reshape DeFi, because people won't need to take big risk for small yield anymore. The yield will be built into the money itself. That's not just innovation, that's evolution. So where does that leave us? In a strange middle ground between decentralization and institution. Stablecoins are the glue that holds the crypto economy together, but they also anchor it back to the traditional system. They're freedom with a backdoor, decentralization with a phone number. Whether that's good or bad depends on what we, as users, decide to accept. Here's the final truth. Money is becoming code. Not in theory, in practice. And whoever controls the code controls the flow. That's why understanding stablecoins isn't optional anymore. It's essential, because they're not just a trading tool. They're the foundation of everything built on-chain, from DeFi to payments to tokenized assets. Ignore them, and you'll miss the quiet revolution happening beneath every transaction. So, when you see the market talk about Bitcoin dominance, Ethereum upgrades, or ETF inflows, remember what really moves value: the digital dollar. The invisible engine behind every bull run, the silent heartbeat of liquidity, the new banks of the blockchain. And as always, this content is for educational purposes only. We analyze data, not dreams. This is not financial advice, it's a reminder. The next phase of crypto isn't about speculation, it's about infrastructure. And stablecoins are the infrastructure of money itself.